Hi, welcome back to the channel. In today's episode, I want to talk to you about what's happening in the Chinese economy. Now, China is the world's largest industrial economy. It's the second largest economy in the world, but it's the largest industrial nation. It makes things and then it exports those things and sells them all around the world. And the latest data that's been published by China shows that the economy is now severely slowing. And in fact, industrial profits have crashed in November. So we'll have a look at that data in a moment. But more importantly, what I want to talk about in today's video is some research that's been published by one of the biggest research agencies in the world that covers China. This is an agency in the USA that is basically being paid by lots of governments and hedge funds and lots of different financial institutions to produce detailed financial information on China. And they are saying that the Chinese figures are wrong, that China is overstating its growth quite significantly. So we'll have a look at that data as well. But before we do any of that, could I ask anybody that hasn't subscribed yet to please hit that subscribe button? It doesn't take a second of your time, doesn't cost you anything, but it really helps me with the algorithm, puts a smile on my face. And also, anybody that hasn't entered my competition yet, whereby you can win my house that's located close to one of the best beaches in the whole of England. You can win that for just a £5 ticket. Have a look at the QR code on the screen now. That'll take you straight through to the link. You can get some free tickets if you buy some. You can have a look in the link in the description below if you don't want to do the QR code, don't want to get your phone out and scan that. And if you're not interested in winning my house, then there's also an option of £250,000 in cash, £250,000 in any currency that you like. So it doesn't have to be in pounds if you don't like pounds or you don't live in the UK. And this is another way of supporting me and the channel. Rather than buying me a coffee or sending me a YouTube super thanks or signing up as a patron or a member, buy one of these tickets. It's a bit more fun and you might win the prize. You never know. So please have a look at that and let's get back into the details. This chart shows the year-on-year change in industrial profits in China dating back to 2020. And obviously industrial profits are a really important metric because it tells us how much profit industry is making. And that's the heartbeat of the Chinese economy. That's what China relies upon for its taxes to be able to fund all of its social investments. And you can see that back in 2020, which was obviously impacted by the COVID-19 pandemic, industrial profits actually increased by 4.1%, which is quite surprising because most countries saw a huge reduction in their output and therefore their profitability. But China managed to navigate a very difficult path. In 2021, when the world started reopening and there was huge demand for everything, and there were actually shortages of lots of things that had been produced by China historically, industrial profits actually increased by 34%. That is a huge jump. And you can see that 2021 represents the record year for industrial profits. The scale on the left-hand side of this chart is shown in billions of Chinese yuan. Roughly speaking, the exchange rate to the US dollar is about 7-1. Keep it simple. So in that year, we are talking 8.7 trillion Chinese yuan of industrial profits. In 2022, there was a fall of 4% in industrial profits, but that was against that all-time high, so not the end of the world. In 2023, they were down by 2.3%, so concern was starting to rise in China that there were problems. 2024, there was a further fall of 3.3%, and the latest data published for November 2025 shows that industrial profits fell by 13%. That is a huge reduction. And just to put this into perspective, 2020 was the year of the COVID pandemic. So that was obviously not a great year for any industrial output. And the figures for 2025 are broadly speaking in line with where China was back in 2020. So this represents a serious issue for China. 13% fall year on year is disastrous. And I've talked about in previous videos the fact that it's estimated that more than 50% of the companies in China are currently banking losses. Now, the reason why Chinese companies are struggling to make a profit is all down to a combination of the price that they're selling their goods for and then demand for their goods. If we have a look at this chart, it shows producer prices, the year-on-year movement in China over the past 12 months. And you can see that the latest data for November shows that producer prices fell by 2.2% year on year. Now, that's bad in itself because it means the companies are selling for 2.2% less. And when you've got an increase in costs, you can't pass that on if you're reducing your sales price. So that's going to squeeze your profit margin. That's one of the reasons why we're seeing profits for industry falling. But I think what's worse here is when you look at the trend, because in the last 12 months, producer prices, factory gate prices, have fallen in every single month. And in some of those months, we've seen really significant falls. In June and July, we were down at minus 3.6%. That's a big fall. And if we widen the scale of this chart to show the last 5 years dating back to 2021, you can see the producer prices have actually been falling for the past 3 years. So every single year, companies in China are having to reduce their prices. And this becomes cumulative because if you reduce your price by 2% this year, and then another 2% next year, and then another 2% in the following year, then roughly speaking, your prices have gone down by about 6% in 3 years. Now, over the same period, Chinese companies have seen increases in the cost of fuel and raw materials and wages. So they will have been going up by at least 2 or 3% every single year. So when you've got an increase in your costs of maybe 6 to 9% over a 3-year period, but your prices are going down by 6%, that is taking a huge chunk out of your profits. And the shape of this chart directly correlates to what we've just looked at in terms of what's been happening with industrial profits. We've got reductions in 22, 23, 24, and 25 as a result partly of this reduction in producer prices. But it's not just down to what's happening with prices because demand is also softening. So if we have a look at this chart, it shows what's going on with retail sales in China. So how much Chinese consumers are spending each month. And you can see that since May, there has been a significant and monthly reduction in the growth in retail sales. So China is basically not buying as much stuff as Chinese companies want it to. If we have a look at this chart, it also shows a really interesting trend. I've split out 3 different lines here. So the yellow line at the top shows trading goods because China subsidizes its retail sales. So in the same way as it's subsidizing its exports by giving money to companies that are exporting goods, so I think electric vehicles is probably the most famous example, where electric cars coming out of China are significantly lower priced than other cars and therefore have been undercutting in many markets around the world. And lots of countries have now introduced tariffs specifically on Chinese electric vehicles to stop this. But it's not just in exports. In the retail market, in order to boost sales, the Chinese authorities offer a trade-in scheme. So you can take, and this relates to lots of different industries, but electronics and consumer goods are a lot of them. So if you've got a TV, you can take your old TV down to the store and you'll get a trade-in value for your old TV, which basically reduces the price of the new TV. And you can see in this yellow line here, the movement, the year-on-year movement in trading good sales. So these are retail sales that have that trading element applied to them. And since the authorities increased the attractiveness of the scheme, you can see there was a huge spike in sales of these trading goods. So what we're seeing here is that the Chinese authorities are artificially driving up retail sales by offering this discount, which is being funded directly by the state. But unfortunately for China, you can't keep doing that forever because you run out of cash. So in the middle of 2025, the scheme was cut back, and you can see that those sales have crashed since then. There has been a huge reduction in the growth in these trade-in sales. And what we're also seeing is that the 2 other lines on here, which are retail sales of goods total, which is the blue line, and non-trading goods, have got a significant downward trend over the past couple of years. So we're seeing a real slowdown in consumer demand. Now, if we have a look at what's going on with exports, which is basically the other way that Chinese companies can sell their products, this chart shows the year-on-year growth in exports over the past 12 months. And you can see that since March of 25, we've got another significant downward trend here. So things are slowing down on the export front, which is not surprising because the biggest single export market for China is the USA. Now, if you've been following the channel, you'll be aware that Donald Trump has hit Chinese imports into the USA with tariffs. Lots of different items are now costing significantly more, and that's led to a huge reduction in the exports from China to the USA. And China is now scrambling around trying to find new markets. It's flooded the European Union, and the European Union is now considering its options in terms of applying tariffs. So Chinese companies are struggling both in terms of the level of demand, both at home and overseas, and also the price that they're selling their goods for, because producer prices are continuing to fall. So this explains why Chinese companies have seen a huge reduction in profitability. But the other thing that I wanted to talk about in today's video is what's going on with the actual figures. Famously, China keeps setting a 5% GDP growth target every single year. And officially, it keeps hitting that number, even though this sort of goes against what we've just talked about. Because how can you get a 5% growth in GDP when industrial output, which is the heartbeat of the Chinese economy, is slowing down? We're seeing year-on-year falls in the profitability of these companies. And obviously, they need these companies to make profits so that they can then tax the profits to feed into GDP. So it doesn't really stack up. If you've got industrial profits falling, the GDP has been rising by 5%, because the other main driver of the Chinese economy over the past 25 years has been the property market. But if you follow the channel, you'll be fully aware that the property market has been completely wiped out over the past few years. Since China introduced the 3 red lines policy, whereby it reduced the amount of debt the property developers were able to get their hands on, we've seen many of those huge businesses becoming bankrupt and illiquid. And China Vanke, which is the state-owned entity, which is basically one of the biggest property developers left, is currently in discussions with its bondholders trying to renegotiate to avoid bankruptcy and basically collapsing. I don't think the Chinese state will allow it to collapse, because they obviously can tell the banks just to roll over and carry on lending more money. But the property sector is completely destroyed. And what we're seeing here is that the industrial sector is also now struggling. And a US independent research company called RHODIUM Group, and if you're interested, rhodium is a chemical element. It's actually used predominantly in catalytic converters. It's rarer than gold and silver, so it's quite a rare earth element. But that's what it's used for mainly, so it's not particularly exciting. It is used in some jewelry, but you can't buy a rhodium ring, for example. Rhodium was established in 2008 and has over 100 economists, so it's a very big institution. And it's paid by a lot of different government agencies around the world for its research, so it's highly regarded. And in a report published on the 22nd of December, titled China's Economy Right-Sizing 2025 Looking Ahead to 2026, it's raised huge question marks over the credibility of the numbers that are published by the National Bureau of Statistics in China. If we have a look at this table, it shows the growth, the real GDP growth published by the NBS, alongside Rhodium's calculations as to what they believe the actual growth has been in China. So you can see in 2024, the National Bureau of Statistics claimed 5% year-on-year GDP growth. The Rhodium Group are saying that it was actually somewhere between 2.4 and 2.8. In 2025, the NBS is forecasting 5.2%. Rhodium is saying that it's going to be somewhere between 2.5 and 3. And in 2026, we don't have the official estimate from the NBS yet, but it's likely to be 5%. Rhodium is saying it's going to be somewhere between 1 and 2.5%. And if we have a look at some of the extracts from the report, it says the gap between China's official narrative and economic reality has been widening for some years. Our adjustments to China's official data from 2022 to 2025 suggest that the level of real GDP this year is around 11% lower than official numbers claim, with most of the adjustment in the investment or gross capital formation component of GDP. This would imply a decline of roughly 9 percentage points of global investment share from 2021 to 2025, which would go a long way to explaining the surge in Chinese exports and growing concerns about China's external imbalances. Counting national GDP is part art and part science, even in the most advanced economies. The miscalculation for China's economy has been persistent for too long, though, and always in the same direction of overstatement. This has obscured global imbalances that threaten systemic risks as countries are compelled to deal with China's vast overcapacity. After years of turning a blind eye to this, the IMF is finally pointing it out. France and the other G7 nations, beyond just the US, are tagging these imbalances as strategic concerns. And while President Trump's plan to chart a constructive course with Beijing in 2026 appears benevolent at first blush, it risks a dangerous collision if it is based on a faulty map of China's economic directions. So, quite a damning conclusion there from the RHODIUM report. They're basically saying that China has been overstating the numbers and basically flooding global markets. So, what's the summary and conclusion today? Well, I wanted to post this video because we've obviously been following what's going on in the Chinese economy quite closely. And what we are seeing is that industry in China is really starting to suffer. We've seen that producer prices have been falling in every single one of the past 36 months. That is a long period of time to not be able to increase any of your prices because globally we haven't seen a reduction in costs. We're seeing fuel costs continuing to rise. We're seeing wages continuing to go up in every economy, including China. Raw material costs are going up. So all of the input costs for Chinese businesses are continuing to rise at the same time as they're constantly having to reduce their prices. And what that tells us is that it's eating into their profit margins. Now, Chinese businesses don't work on big profit margins anyway. Their whole model is based on make lots of things and sell them very cheaply. So it's a volume-based business. You need to be selling millions and billions of items just to make a very small profit. So when you're cutting your sales price, that's going to wipe out that very small profit very quickly. We've talked about this many times before, but it's estimated that more than 50% of companies in China are now reporting losses. So that's an absolute disaster because if you're loss making, then you can't continue. The only way that you can fund losses if you're a business is either from your savings, if you've built up a huge amount of cash in the past. But clearly, if you've been cutting your profits for the last 3 years at least, then all of that cash will have disappeared a long time ago, or from taking on more debt. And that's what Chinese businesses are doing. They're taking on debt to fund their losses. But clearly that's not sustainable because you're illiquid, you're bankrupt. You can continue while the bank continues giving you more money. But as soon as that line of credit is closed, then that's game over. You're done. You basically have to close the business down. And we've seen this with a lot of property businesses over the past few years. They hit the wall 2 or 3 years ago. They ran out of cash, they ran out of debt, and many of them, including Evergrande, which is probably the most famous of all, have become bankrupt and illiquid and closed down. So they've disappeared off the face of the earth. But obviously, from China's point of view, they can't close down the whole of its industry because that's what the Chinese economy is built upon. That's what it relies upon for all of its tax revenues. So China isn't producing anywhere near as much industrial profit as it was. It's down 13% year on year. And that follows on from reductions in 24, 23, and 22. So we've seen 4 consecutive years of falling profits in China. That isn't a sustainable model. But the Chinese government continues to talk about 5% year-on-year GDP growth, which does seem counterintuitive given what's going on with Chinese industry. And what we talked about in the second half of today's video is that the RHODIUM Group, which is a well-established independent research company that focuses on China, it's producing lots of really detailed data for governments and companies and financial institutions all around the world. It's saying that China's figures aren't correct, that they've been overstating the numbers, possibly by as much as 100%. So whilst the Chinese authorities are saying that China is growing at 5%, job done, everyone's a winner, RHODIUM are saying, well, actually, we think it's more like 2.5%. And going forward, it could be as low as 1 or 1.5% for 2026. Now, if that is correct, then that completely undermines the whole of the Chinese economy. Whilst it's saying that it's the second biggest economy in the world and it's growing at a faster rate than the USA, The reality is that it isn't if rhodium is correct. And they're basing this on a lot of detailed information and research that they've done. So I think what this tells us is that the situation in China is potentially a lot worse than the official figures are showing. They're showing that everything is motoring along quite nicely. But when you look at the details, it doesn't really stack up. How can industrial profits have been falling for the past 4 years and have seen a 13% year on year fall in November, but the economy is still hitting 5% growth? Because the other main driver for the economy is property, and property is completely in the toilet. That is completely bust. So there is no way that the property sector is driving GDP because Chinese consumers have completely lost confidence in property. It's very difficult to sell a property now. Prices have been falling month on month for a long time. None of the property development companies are making any profit. So property is a write-off, and it looks like industry is heading down the same road. So I wanted to post this video firstly to tell you about what's happening with industrial profits, but also to talk about this RHODIUM Group report, which basically throws a huge question mark over the credibility of the official figures coming out from the National Bureau of Statistics for China. So hopefully you've enjoyed today's video, you found it useful, informative and thought-provoking. If you have liked what I've said, then please give me a thumbs up. Please subscribe if you haven't done so already. Don't forget that I'm offering an opportunity to win my property, which is located close to one of the best beaches in the whole of the UK. It's another way of funding the channel. So if you're interested in that, please buy a ticket. If you're not interested in my property, then don't worry, because there's an alternative prize of £250,000 in cash. So that's got to be worth a punt, hasn't it? So if you've never supported the channel before, have a go. Buy a ticket, scan the QR code on the screen now, have a look in the link below. Thank you so much to everyone else that's supported me. If you've bought me a coffee or sent me YouTube super thanks or signed up as a patron or a YouTube member or a Buy Me a Coffee member, really appreciate your support. Really helps to keep me going and making more videos. So thank you so much. And here's something to put a smile on your face.